Hi, welcome back. This is the first of a series of 14 what I call master processes that small business leaders need to be observing and monitoring. I know it's this is a live. It is 8:34 here in Memphis, Tennessee, as I'm delivering this after a very long day of working with clients. So I'm excited to share this information as a consultant and a organizational architect that helps small business leaders to grow their business for over 36 years. I wanted to share these areas that you need to monitor. And I realized yesterday when I disclosed the 14, I forgot to really mention that there's a group of smaller subtitle or sub processes within each category. And these are really designed to help you monitor the success of your organization on an ongoing basis. And that's what we're really looking for is how do you monitor things that are important? And each step along the way, as you grow your business enterprise, will need to have attention paid to one or more of these aspects. Now, today we're going to be talking about the financial processes, and these are the things, the data that helps you forecast, strategize, capture, control, and report on all financial aspects of the organization. And there's some that just seem common sense, but I'm going to share a few little applications of things that I've actually run into either in my days as a turnaround guy, putting companies back together that were in financial stress, or during the banking era, or just what I've learned through the years in working with small businesses and running my own small business for 36 years. So let's start off. I know these are pretty common grounds here. You need to know what your accounts receivables are. You need to monitor those. I know that sounds kind of trivial. However, remember, cash is king in small businesses. Cash is everything. If you're not paying attention to your cash, you got a problem. So a lot of times that starts with cash receivables. Now, if you're a cash-based company, you don't have this to worry about. You just take cash in or credit cards and you have the money available immediately. But there's a lot of us out there that invoice our clients, and we get checks or deposits into the account electronically, but yet we still have to monitor those receivables, and sometimes we have to put limits. I do know that sometimes if our credit is too easy, then and we get let's just say gifts from clients or customers that fall out of the sky, well, we have to be careful because they probably have a problem with their existing company that they're working with, and they're going to use you as their financial arm for a period of time. So you have got to monitor the credit worthiness of your accounts. You also have to monitor how long it's taking to pay. Now, a related and sister account or process to monitor the accounts payable. Now, this is something you just need to track who you owe money to. You've got to make sure that you pay these bills to maintain a high credit rating, because it does get reported through the business bureaus and the better business bureaus and credit associations. So people will check you out, and you must guard your credit at all costs. Now, one of the things that I learned one time, remember I was talking about cash flow, and we have to monitor cash flow. In my days of banking, we were always balancing assets and liabilities. And I learned this concept while I was in the banking industry, but I've also seen it in turnaround work as well as working with healthy companies that are trying to figure out what was happening to their cash flow. And here's a situation that we ran into one time. We had a company that was cash poor. They were constantly running out of cash to pay their bills, or just they became in violation of their loan agreement because their cash balances drop below a certain level. And what we discovered is the accounts receivable, or the accounts payable group was actually paying invoices as soon as the invoice showed up. So they were like net zero. I mean, invoice would show up and they would send out a check. Yet on the other side of the equation, the accounts receivables were taking 90 days to be collected. Now, if you think about that, 90 days versus zero, that is a spread that you have to monitor because it is not a healthy spread. You're actually running out of cash in a hurry unless you just have an abundance of cash and you feel like you can do that. And this particular company had operated with an abundance of cash for years until all of a sudden they hit a speed bump in the highway and lost a lot of money, and then that drained their cash reserves at a healthy rate. So this is something, I mean, this is just a sample of what you could monitor, balancing those receivables and payables. And in this particular case, we instituted a policy of paying the accounts payable on the due dates, and that immediately improved the cash balances within the company, because there was now the opportunity to have some float time. As monies did come into the account, they got to sit a little bit longer until the actual payment was due. They also negotiated payment terms on some of their larger suppliers that matched their receivables terms, and they were going one-to-one. That's another strategy to be utilized. Yet if you don't know that, if you don't track it, you wouldn't know that that's in play. So there you go. I mean, you've got to be paying attention. Now, profit plan or budget plan is also helpful. Not as important with the really small companies, as you're still dealing in chaos and new opportunities and changing opportunities on a regular basis. Yet at some point you do need to begin to structure some budget just to know where your money is going, where it's coming from, and monitor that so that you can keep everything within a plan, so to speak, or within a budget. So you just don't overspend on the wrong things. Now, this fourth item is cash flow. Are you doing a cash flow analysis? Again, remember what I said. In most small businesses, and particularly in stages 1 and 2, you have to, well, cash is king. I mean, you've got to be paying attention to your cash. You've got to manage the cash with excellence. So the cash flow analysis is extremely important and should be being done on a regular basis so that you know what's coming in, what's going out. Are we having to borrow money? Are we using our lines of credit, or are we using our cash flow? And obviously, the more you can use the receivables and the cash from sales, which, you know, the faster they come into your accounts, the better off you are. And that's a goal. So you have to monitor this data so that you can anticipate what's going to happen. Also, if you use a cash flow analysis that projects out a little bit, you will know if your lines of credit are sufficient, or you're going to have to run some promotions in the sales category to drive sales to keep the growth going, but also manage that cash. Because if you've blown out your line of credit, you have no cushion. Your safety net is gone. So then you have to go to a secondary or actually the primary strategy of growing sales organically. And that may include promotions or special events just to drive some cash into the accounts. I know that there's a gentleman that uses a process called the 4-day cash machine, where they put a timer for a sense of urgency on special deals. And it's a very special deal, yet it's designed to drive cash flow in the short term. But that's just something that you would be aware of if you were doing cash flow analysis. Then you have the profit and loss statements. Now, most of the time, people just do a general profit and loss statement. But what I'm going to recommend is you go by revenue group or by channel. So, in other words, you've got to identify where your revenues are coming from and monitor those to make sure that you've got enough revenue to cover the cost of those particular channels or revenue groupings. And I do it even in with our small company. We've probably got 5 different channels that we monitor to see what is the profitability of each one. We want to know the most profitable ones because those might be the ones we need to spend more time focusing on, and the ones that may be generate or moving towards more of a commodity based pricing where we may be losing money because we just can't get the cost down. Well, that's something we have to monitor too. Along those lines, you also have the balance sheets, and that's a picture in time of your assets and liabilities. You really want to have a positive number on the owner's equity or the stockholders' worth, not a negative. If you're negative, you're technically bankrupt. So just be aware of that. And just monitor those numbers. I use it to check and make sure that everything is staying steady. When I get mine on a monthly basis, and I examine percentages, and I use it to also create my cash flow analysis because I want to see how the payables went up or down. That would indicate an impact on cash. The cash account itself, receivables. If they go up significantly, I know that that's going to impact my cash flow in the future, but it may be short in the current. In fact, I'll go so far as to say, if you have a high growth company, if you've got one, what I call a hyper growth company, you really have to pay attention to this balancing act of receivables with cash flow and the balance sheet and the income by revenue group in order to make sure that it's all balanced out. Because what happens is if a company grows too fast without capital, which is a trait of the stage 1, stage 2 companies, without that capital base and the cash base, they can be caught literally outstripping their resources because all their cash gets tied up in receivables, particularly if the companies they deal with are the multinational large corporations, which have a tendency to hold payment for 45, 60 to 90 days before they actually make payment on their receivables. And they have a funny way of calculating when those timelines begin. Each company is different, so you have to know that. The gross and net profit amounts, and again, if you can do this as a company as a whole, as well as your revenue group, channel groups, you can actually track how well you're doing as far as selling value add, or if you're in commodity, then you know that you've got to turn up the volume in order to create greater gross profits and ultimately net profits. Because you do have in all of this, you also have fixed cost, you have variable cost. You've got to balance that. Now, I didn't put a break-even analysis in here, but it's definitely in play as a financial process to monitor. And then finally, in this particular grouping, and for tonight, I want to talk about inventory control. Inventory control is a financial aspect. You have invested cash into inventory that you need to turn. Now, in this particular area, you need to monitor your inventory totals and the turnover ratios of the inventory. How fast are they turning over? Ram Charan, he calls this velocity. The greater the velocity of turns, the greater the profits are for companies, even with smaller margins, because you're selling more and you're restocking to keep a perpetual inventory, and then you're selling again, and your turnover, inventory turns are greater, which allows for greater profitability and long-term stability and success, because you're making more money organically. And when I say organically, that means in the natural phase of business, you sell something, you execute value, and you get something in return. That's the basis of everything, and that's the basis of tracking your profit and loss statements. Is it's very simple, yet it can be complex as far as the number of different accounts and the complexity of your cost accounting systems. If you're a manufacturing company, you're obviously going to have more things to think about. You've got work in process as well as finished goods and inventory. You've got your raw goods. Again, just-in-time delivery for inventory control is a great thing if it comes in just at the right time. There are companies that use perpetual inventory, where they have a stated amount of inventory by each product line, and that's all they will stock, and they monitor it in real time as inventory moves off the shelf, so to speak, or out the door. It's subtracted, and then orders are automatically placed at the end of the day, or batched for the end of the week when deliveries are made, like with distribution companies, let's say. So you're monitoring how often things move out. And of course, then I'm getting a little techie here on you, but you're also looking at, if you have contracts with clients that you know that you're going to sell a certain amount of product or services each month or each week, then you can project those numbers a little tighter, manage your inventory, manage your balance sheets, make sure that your cash flow is sufficient, and maintain control of your receivables versus your payables, because things are turning fast, and you are actually creating more and more cash on a monthly basis. Now, the reason I'm spending time talking about these processes is each one of them usually is a source for correcting a negative situation within an organization. And if you understand these concepts, then you can utilize them to correct whatever situation is in play. And again, with all the experience that I've had in both the banking, where I was actually lending money to the organizations, and I had to analyze all their companies and figure out what made them tick, and then the turnaround days of putting financially dysfunctional companies back together. This was easy. I mean, not easy, but it was experience that I was gaining to help me help the healthy companies that I work with today. And therefore I totally enjoy this, and I can relate to the numbers that you have to track. So with CFOs, they have a great responsibility. CFOs only come as the company gets bigger. The smaller companies, it's on the entrepreneur. Myself, I am an entrepreneur, so therefore I have to pay attention to these numbers on a regular basis, monitor them, make adjustments, make decisions that impact these numbers and the financial situation of the organization. If I don't do that, we could find ourselves overnight, like struggling or going, oh my, what are we going to do next? And this is all part of being able to put your head on the pillow and sleep well at night without worrying about your cash flow or profitability and where money's coming from, because you've examined the processes and they work like every week, every month, and you can begin to have a certain level of comfort knowing that certain numbers are going to occur. And if those numbers are slightly off or different, you know that there is something going on. You have to step in and make some decisions. That's where I'm coming from. These are all processes, by the way. Every one of them is a process. You've got to understand the processes and all the nuances of the processes to help you function at a very high level. And with that, I just want to thank you for your time today. I'm going to also ask you, please put a comment down below what you think. If you've got additional questions, I'll be more than happy to answer them in the comment section as I see them. So please do that. If there's something that you want to explore in greater detail, please let me know in the comments and I will follow up with you. Again, I'm not selling anything today, so I just want to share this information with you. I know it's late, but I had a very busy day helping my clients succeed and improve their situations, and therefore I'm kind of late coming on the air tonight. Yet I appreciate your time, and I look forward to being back on here tomorrow, where we're going to talk about customer intelligence and all of the things that go with customer focus. What processes can you develop and deliver in order to monitor your customers? All right. So thank you very much. You take care. Have a great week, a great day, and I'll see you tomorrow night.